Welcome to the Stock Market Palantir. Today we are going to talk about EPSM. Few tickers this year have captured the bizarre decoupling of price and value, quite like FCM Enterprise Limited, NASDAQ, EPSM. We're talking about just extreme volatility, a stock that violently ranged from what, $1.40 all the way to an intraday high of $155, all in the span of Q3 2025. I mean, a price swing of that magnitude with no real positive corporate news, it begs a crucial question.
It really does. I agree. EPSM is a singular event, a textbook case of dislocation. But the core question for us here is one of really market philosophy. Was this movement, this catastrophic volatility, was it fundamentally a demonstration of market failure, meaning the mechanisms for rational price discovery completely broke down? Or was it just the predictable, albeit extreme, consequence of some very specific market mechanics that actually operated exactly as you'd expect?
And that's the heart of it. My position is that this event signifies a profound failure of that price discovery function, coupled with a pretty worrying breakdown in the operational integrity of the whole settlement system. The market just ignored the fundamental reality of the company to such an extreme degree that the price was, well, it was completely irrational.
And I come at it from a different angle. I view the EPSM event not as a failure, but as let's call it a severe stress test that really exposed some deep structural vulnerabilities. The outcomes, that massive spike and then the collapse, they were mechanically determined by exploiting an extremely low float supply and the fragility that comes with a toxic capital structure. The market, in my view, behaved logically within some very unnatural constraints.
Okay, well, let's ground this in financial reality, because this is where the failure is just so obvious. The underlying business here is Compañía de Comercio Las Limitada. It's a Macau-based luxury liquor distributor. And we are talking about a shrinking asset base. The price action was entirely, completely decoupled from its dismal performance. The evidence is, it's staggering. Total revenue collapsed 57.12%, falling from around $29 million to just $12.5 million in 2024. Net income dropped 92.52%, landing at a meager $274,000.
Right, and I'm not denying the severity of that decline, but let's look at the result of that disconnect through your lens of fundamental failure. When the stock peaked at 155, that implied a market cap of nearly $1.85 billion. Do you realize what that means? It resulted in a price to earnings, a PE ratio, exceeding 6,000 times trailing earnings. That is statistically absurd. It really just confirms your point that valuation broke down completely.
Absolutely. And this failure spilled right into the operational side of the market. The massive spike in fails to deliver, or FTDs, peaking at 99,064 shares on September 29th, that is concrete evidence that the settlement system just couldn't keep pace. For listeners less familiar with the term, FTDs happen when a seller just fails to deliver the promised shares on the settlement date. A number that high confirms a severe breakdown of market integrity.
I see why you characterize the FTD spike as an operational failure, but I would argue that FTDs are an effect of structural illiquidity, not necessarily the cause of the market failure. Let me give you a different perspective, one rooted in the structure of the stock itself. The volatility wasn't irrational. It was an inevitable consequence built directly into the stock's architecture.
So which is what, precisely? What's the core of that structure?
EPSM is a classic low-float asset. The tradable float, so that's the shares actually available for the public to trade, was estimated to be only between 2.08 and 2.64 million shares. When we talk about a low float, we mean there is just not enough supply to meet even moderate sustained demand.
Right, but a small float alone doesn't mean the price has to jump 100-fold. The thing is, other small companies manage to trade without these, massive nonsensical spikes.
But a small float meeting concentrated institutional or algorithmic demand creates what we call a vacuum-up effect. Think of it as sucking all the air out of a room. When demand severely outstrips that limited supply, market makers, who have to provide liquidity, are forced to raise their bid prices aggressively. They aren't doing this because they believe the macroeconomic market is booming. They are doing it because they have to induce any legitimate seller to part with their shares. The price move is purely mechanical. And on top of that, consider the shorting activity. The off-exchange short volume ratio was high at 41.22%, which suggests sophisticated players were actively shorting this low-float stock in dark pools. For listeners, that ratio tracks short sales outside of public exchanges. So when you have sophisticated shorting, meaning extremely limited supply, you create this highly pressurized environment. It's a guarantee of explosive moves once any real buying pressure hits. And it's completely independent of the business itself.
That's a compelling argument about the microstructure, but it requires us to willfully ignore the core mandate of the market, which is efficient capital allocation. So let's tackle our first main point, the weight of financial reality versus trading mechanics. How can you defend market efficiency when that $1.85 billion valuation was placed on a company that was so clearly facing a liquidity crunch? I mean, they were taking out small, high-cost loans like $130,000 at a staggering 20% interest. This isn't a company ready for a massive valuation. It's a company in distress.
I would frame market efficiency differently here. The market is efficient at processing supply and demand constraints, even if it ignores fundamentals temporarily. That price of $155 was a transient equilibrium price. It was the price required at that exact moment to satisfy demand and locate supply in a deeply illiquid environment.
But surely you have to admit that the fundamental value shouldn't be ignored for that long.
Well, the fundamental value was eventually asserted when the stock collapsed back to the $1.40 range. The question isn't whether the price was rationally valued, but whether the market mechanism functioned efficiently to match buyers and sellers under extreme constraints. I mean, when volume day saw turnover of up to 40% of the entire available supply, the price move to $155 simply reflects the mathematical cost of acquiring those shares in a vacuum. The market was functioning perfectly to clear trades, not failing to allocate capital.
Yet this functionality came at the cost of rationality, confusing true investors and causing huge instability. Even the company itself acknowledged this profound disconnect. Their press release responds to recent unusual trading activity, stated that the volatility was, and I quote, not related to any changes in its underlying business fundamentals. When the issuer itself says the market has lost the plot, that is strong evidence of a fundamental market failure. The disconnect was just too extreme.
The magnitude was extreme, yes, but structurally predictable. And this leads us perfectly into our second point, the role of the toxic capital structure. I argue that the toxic financing provisions weren't just incidental. They created the ticking clock and guaranteed the severity of the crash that followed.
How so?
We saw small loans at 20% interest, a distress signal itself, and the issuance of shares with reverse split protection for the lenders. This is critical. For the listener, that protection means if the company has to do a reverse stock split to stay on NASDAQ, the lenders are guaranteed their equity position won't be diluted relative to everyone else.
A vicious clause.
Exactly. These clauses shift the entire burden of dilution and risk onto the common shareholders. This inherent risk profile made the ultimate crash down to $1.42 entirely predictable once that initial mechanical squeeze failed. The capital structure was basically designed to create volatility and risk for common stock, and the market simply fulfilled that design.
Okay, I have to pivot here. While I agree the financing structure was deeply toxic, and it certainly accelerated the crash, I'm not convinced it caused the initial punk to 155. I think the financing was just the means of destruction. The real catalyst for that relentless downward pressure, that wall of supply, was the 180-day lockup expiry in late September.
That's an important distinction, cause versus consequence.
Well, consider the incentives. Insiders and pre-IPO investors had acquired shares at a cost basis of around 2 cents. Even if the stock crashed to $10, selling was a massive return. When that lockup expired, those individuals, including the CEO who filed a Form 144 to sell, well, they could finally liquidate. That Form 144 is the notice to the SEC of an insider's intent to sell. It signaled a huge potential supply dump,
So you're arguing that this sudden, predictable flood of 2-cent shares was the true pressure point?
Precisely. This influx created a massive, steady flow of supply that just completely overwhelmed any remaining demand. This sudden, cheap supply is what ultimately triggered that dramatic FTD peak on September 29th. Market participants, especially shorts who'd been squeezed, were desperately trying to locate shares to settle this flood of insider sales. So yes, the toxic debt set the stage, but the lockup expiration was the executioner that crushed the price.
I see that as the lockup expiration being the moment the mechanical transition happened from a volatile squeeze driven by demand to a catastrophic distribution driven by that unlocked supply. And this transition from scarcity to sudden abundance, it just underscores my argument that the entire cycle was structurally determined and predictable. The volatility was built into the sequence of events from the start.
But if we accept that it was purely mechanical, we have to look at our final point. The nature of this ghost squeeze. Unlike the meme stocks we all remember, there was a distinct absence of mass retail coordination here. We saw negligible presence on Wall Street bets, no big due diligence library. This completely refutes the easy narrative of a simple retail frenzy.
The lack of retail is an excellent observation, and it does support the idea that concentrated capital, not disorganized retail, was driving things. But I still don't buy that this indicates a failure in market physics. It just indicates a different source of demand.
I think it points to a much deeper failure. The theory gaining traction, and this might sound a little out there, suggests that high-frequency trading algorithms may have been tricked by data pollution, specifically confusing the EPSM ticker with discussions about the vintage Ensoniq EPSM synthesizer.
That's a fascinating hypothesis, that a synthesizer triggered the squeeze. But even if it's true, what does that mean for our debate?
It means the entire mechanism of HFT is deeply flawed. Algorithms designed to trade on velocity or sentiment fail to apply a basic reality check, allowing the price to soar based on a data error, not scarcity alone. This reliance on flawed data highlights a deep systemic flaw in our current trading structure, which failed to prevent this spectacular mispricing. That is a failure of sophisticated systems.
That's a compelling argument against HFT reliability, but isn't the source of the demand ultimately irrelevant to the structural outcome? I mean, whether the capital came from an institutional short covering, private chat rooms, or even confused HFTs chasing a keyword, the physical mechanism was the same. Demand outstripped the severely limited supply.
But if the demand is irrational based on noise, then the resulting price is irrational regardless of the float. The market isn't just supposed to clear trades, it's supposed to aggregate rational beliefs about future cash flows.
Look, the ghost squeeze isn't evidence of a failure in market physics. It is simply evidence that concentrated capital can exploit these low-float structures with extreme efficiency. The resulting price move, the vacuum up followed by the catastrophic distribution enabled by the lockup expiry, was the mathematically predictable result of the constraints the company imposed on itself. The mechanics worked perfectly, even if the premise, the synthesizer, was absurd.
At the end of the day, I maintain that the disconnect between financial reality, that 57% shrinking revenue, and a valuation of nearly $2 billion cannot be excused by microstructure alone. The structural components like the settlement system failing and the reliance on flawed HFT logic, they fail to prevent a massive mispricing anomaly. This event, in my view, profoundly erodes confidence in the price discovery mechanism. The system just proved inadequate.
I do acknowledge the concerns about erosion of trust, but the anomaly was engineered into the stock's DNA. This event was a mathematically predictable extreme outcome, given the low float, the shorting, and the critical lockup expiry. The volatility wasn't a sign of market failure, but the inevitable, self-correcting violence resulting from highly constrained supply meeting demand, which then triggered the planned distribution phase.
Regardless of which perspective you favor, the episode provides a crucial case study into the sheer fragility of the microcap environment when financial engineering meets structural constraints.
Indeed. And whether you classify the $155 spike as a fundamental misallocation or a predictable structural outcome, the underlying risks remain stark for the ticker today. We have lingering NASDAQ compliance concerns, with the stock trading dangerously close to that $1 minimum bid. And crucially, there was the overhang of those remaining pre-IPO shares, which continue to pose a major threat to the current price. The price action will continue to be determined by those structural risks.
A crucial consideration for anyone looking at this ticker going forward. Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.